Good morning to all our clients and guests, and welcome to today's webinar, ZAR Outlook and Moving Target. Our speakers today are John Cairns, Client Strategist at RMB, Kim Silberman, Fixed Income and Currency Analyst at RMB, and Shanila Khan, Client Structure at RMB. Our speakers are going to be taking us through, firstly, what has transpired in the financial markets over the last couple of weeks that has resulted in the Rand's recent depreciation, as well as our outlook for the remainder of the year and the moving parts that are driving that outlook. Shanila is going to be taking us through what's currently being discussed with clients to provide you with some guidance on how best to manage your exposure. Okay, we're going to start off with John this morning. Good morning, John. If you could please give us a recap of what's been happening. I know you've been on leave, but I'm sure you've all caught up now.
Thank you, Kim. Good morning, everyone. I would attribute the Rand weakness to four large issues, and it's worth unpacking these in the context of whether those factors are still in place. In other words, if they can drive further weakness. The four factors: we had the Absa Barclays deal, a large transaction. Arguably, that set off the Rand weakness. Obviously, that's now completed. No further impact on the currency from that. The second one, and this, in my mind, is probably the biggest issue. There has been a clear adjustment in global market thinking towards commodity markets. You see this reflected in resource equities really having had a terrible late April, dropping off significantly, and we see the change in the assessment towards commodities reflected in commodity currencies. So pretty much most currencies, in fact all currencies except the Russian ruble, have weakened against the dollar, and I'll get back to the dollar in a moment. All currencies except the ruble have weakened against the dollar in the past few weeks, but it's certainly been the commodity currencies that have really borne the brunt of the adjustment. So again, a reflection of the change in market thinking towards commodities. We see that also clearly in market positioning indicators. In the middle of April, the markets were extremely positive towards commodities, and in the positioning indicators, we see they had close to record long positions in these commodity currencies. The latest report, I paid a lot of attention to the Morgan Stanley report, shows that the market traders, in other words, traders, hedge funds, have now got close to record shorts in commodity currencies. So we've switched from very long positions to very short. Now, again, if we think of that, yes, the market can still go even shorter, the Rand and other currencies, but quite clearly that has already gone a long way in playing itself out, from extreme longs to extreme shorts. Okay, most of the adjustment there has been done. The third of the four factors is simply the financial market turmoil that we're seeing internationally. The S&P 500 index is now 16%, is down 16% year to date, one of the worst starts to the year on history. We've seen credit spreads wider, bonds wider, turmoil across many financial markets. So severe volatility, risk off, and the Rand usually does very poorly in that type of environment. Obviously that turmoil can continue, and we'll be looking at particularly US economic data, inflation, growth figures in terms of driving that. So how much must the Fed hike? What will US inflation be, etc. The fourth driver of the Rand weakness has simply been dollar gains. So a period of quite intense dollar strength, dollar index breaking through repeated highs, pushing at levels that we haven't seen in decades. My proxy for dollar strength is usually just simply euro dollar. There we've seen euro dollar all the way down to the 105 level. As we stand, the market for a week has been battling to get through 105. So possibly, just possibly, the dollar strength is ebbing at these type of levels, but quite obviously that is a factor that can continue to play out. So further dollar strength, particularly on Fed hiking, would then put the Rand under pressure. So Kim, just to summarize, four issues that drove the Rand weakness. Two of them have already run their course. Okay, the Absa Barclays deal and the adjustment in positioning on commodity prices. But still some risks from the other two: ongoing turmoil in financial markets, a very volatile period, and then whether or not the dollar will continue. I'll hand back to you, Kim. Thank you.
Thank you, John, for that recap. Kim, your dollar rand report came out last week. Could you take us through the factors that form the basis of your view, please?
Yes, sure. I'm going to share a presentation with you, if that's okay. Let me just share my screen. You'll let me know if you can't see it. You should be able to see it now.
Thanks, Kim. We can see it.
Okay, great. So this is really outlining what John referred to. So we're in a risk-off environment, and one of the big reasons for that is that you've got the US real interest rates rising. So when you have US real rates falling, that, you know, from a carry trade perspective and a search for yield, obviously you've got cheap funds coming out of the US, and therefore the return that you look for doesn't need to be as high in emerging market assets. But when you've got US real rates rising, that changes the whole story. Whether you're looking at equities, currencies, bonds, you know, it's going to put pressure on all of these risk assets to deliver higher returns. So what the slide that I'm showing you here, what you can see is, you know, the last time the Fed started hiking, so from 2015, I think up to 2018, 2019, that was the hiking cycle, and you can see US Treasury yields rose to around just over 3%. And currently you can see the same thing happening in US Treasury yields. We're back to around just over 3%. The difference this time, if you look at this bottom chart, is the inflation expectations. So over that period previously, inflation expectations a lot lower than they are currently, which means if you translate that into real rates, the real rates are nowhere near where they were in the previous hiking cycle. So, you know, intuitively you can see that as the Fed increases the policy rate, it sort of at least needs to get back towards the real rates of around 1.5%, and that means with inflation at these levels, we need to see US Treasuries rise more than the 3% in order to get real US Treasury rates up to that over 1% level. So that tells you that US Treasury rates are probably going to keep rising to account for the fact that they need to become increasingly real, and you can see what that means when you look at inflation expectations. So pressure is still upward on US Treasury rates, I would think, and that means risk off is going to continue to dominate markets in the second quarter and probably into the third quarter of this year. Yeah, we've also seen, I mean, what you're seeing in the war that broke out, Russia-Ukraine war on the 24th of Feb, is the stagflationary bias that has played out in the global economy, where you've got rising inflation, but risks of recession. So both of those things playing out together have been exacerbated by the Russia-Ukraine war. Obviously, from the commodity prices going up because there's supply chain issues, you know, there's additional pressure on commodity prices and inflation, and that means central banks are being forced to look at front-loading their interest rate hikes because of these additional inflationary pressures. And once you're front-loading hikes and you're hiking more aggressively than when you thought commodity prices would bring inflation down, which is the world we're now in, then those additional hikes are going to be priced into growth. So you've got additional hikes trying to combat the additional inflation, and that is creating fears around a coming recession. So the stagflationary environment is, you know, the worst environment really for risky assets, and that's the background for this risk-off environment that we're facing. So it's quite sort of unprecedented, and I'll show you that in a couple of slides, the kind of the change in the monetary regime in the US, because their levels of accommodation were at unprecedented highs, and they now have to start to unwind that. So the unwinding will also be unprecedented. And just to add to the risk-off environment, so you've got the uncertainty about what all that means for asset prices. So if you're going into an environment that's unknown, it creates an additional uncertainty premium that needs to be priced into risky assets. This is our fair value. So for those of you who are familiar with the fair value model, I do it in 3 stages. So fair value 1, which is that green line there, but sort of between 13 and 14. This goes from 2019 out to the end of 2023. So that is a regression of US dollar ZAR versus inflation differential. So it's basically just your purchasing power of parity PPP model based on inflation differentials, and you can see what that means for the fair value of the currency, sort of around the 1350 mark. And then if we add in commodity prices, you can see the fair value 2, so that's inflation differentials plus commodity prices, and that shows you that commodity prices have been so strong, they've actually brought that fair value below the fair value 1. Okay, so that is at around 1280, 1290 at the moment, going to around 1310 at the end of 2023. So that would be your fair value in a kind of risk neutral environment. And then if we have fair value 3, that's where the currency goes if you're in a aggressive risk-off environment. You can see we're at around 17 there. I wanted to highlight with this arrow that with this model going back historically, this is probably one of the widest ranges we've seen in the fair value, these 3 fair value estimates. So I think the message there is, the fundamentals moving the currency allow for a large trading range. That trading range is sort of historically large. So to bear that in mind, that the moves in the currency, depending on what happens to the macro fundamentals, are larger than usual, the potential moves. This then, this dotted line is our this is actual and forecast, and that is the fair value for the forecast for the currency based on these 3 fair value estimates, and I'll show you the forecast numbers in the next slide. But what I've done is I've added in some assumptions around the dollar. So the dollar, because it's moving and is not, so usually you wouldn't put the dollar in a fair value model because it's supposed to be quite stable as the reserve currency. As we know, the dollar hasn't been stable and is quite volatile at the moment, responding to the changes in the global environment and US monetary policy and EU monetary policy. So it's going to be volatile for quite some time. And I think it's going to continue to play a large role in where the rand trades. Consequently, we've added the dollar assumptions into these fair value forecasts. What you can see firstly, so these are the dollar assumptions in the second quarter, 105, then 100, then 97 over the year. And firstly, it increases the fair value, i.e. the fair value estimates of the rand are quite a lot weaker once you include the fact that the dollar is so strong, which makes sense. Also, it narrows this range, the trading range. So I also wanted to, so the next slide will go through the actual numbers, but just in terms of the assumptions I've made around where the dollar can trade. So this is, I've used the US dollar index and in doing this analysis. So the 105 relates to the DXY index, and that's where it is currently. So a euro dollar of about of around 1.05 actually as well for the euro dollar, and then going towards sort of 113, 115 in euro dollar terms. So that's, if you want to look at it from a euro dollar perspective, that's the range we're looking at for the dollar. So this chart, this is the real rate differential, the yellow line, between the US and the EU. And that's a large driver of the exchange rate, that exchange rate. And then the blue line is a 6-month change in the Fed balance sheet. So, and then below here you can see that is the DXY index. What you can notice is the dollar went through a period of weakness up to 2014 and then a period of strength post 2014. And that translates at the top, these sort of broad cycles, the broad structural changes in the dollar, with a environment where the US real rate was lower than the EU real rate. And then when that real rate differential rose quite substantially to favor the dollar, then you see this strong dollar environment. So those are your two broad structural moves in the dollar. And then around that, of course, you've got this cyclical move in the dollar. That cyclical move in the dollar is driven by the 6-month change in the Fed balance sheet, which is your quantitative easing. Obviously, every time you have an increase in this in the Fed's balance sheet, you can see that you've got easing of US financial conditions. And as the US financial conditions ease, so every time here you can see the Fed balance sheet increasing, and then these gray bars show easing of US financial conditions. You can see that means the dollar weakens, okay, in these easing financial conditions. What we're facing now is both a rising in the real rate differential, and you can see the kind of accommodation in the Fed balance sheet, the recent one in response to COVID, is unprecedented. You know, it's so much larger than what happened in QE 1, 2, 3. And now the unwinding is also unprecedented, right? So you've got both the rising in the real rate differential and the falling in the Fed balance sheet as QT takes hold. And what you can see here, if you draw a line from where the dollar is now, you know, that when you've got both a tightening from the real rate differentials and the unwinding of the balance sheet, then the dollar should rise above 100, is my reasoning. So I think the risk here is that you could see more US dollar strength than the 100. But I didn't want to make the RAND forecasts all about the dollar, but I do think we have to take that into consideration. So those are the upside risks on the dollar. But you could see, you know, that we needed to move above the 100 at least to respond to what we're seeing in terms of the quantitative easing in the US. I think what we've also seen now, the response from the EU, they're looking to tighten monetary policy increasingly as well, and I think that's also something that could keep the dollar, you know, from strengthening too far. So fair value estimates. Without the dollar, if you just look at the fair value of the currency without dollar strength, we're at around 1290 at the moment, moving to 1310 and then 1360. And if you add in the dollar fair value, so there's the dollar of 105, then including the dollar, your fair value is at 1620 in the second quarter of this year. Staying at around 16, falling to 1590 by the end of the year, and then strengthening a bit, but ending the year again in 2023 at 1590 due to growth concerns. So in that context, our forecast for the RAND is to average at a midpoint of 1550 in this second quarter. So broadly between these two ranges, right? The fair value, including the dollar and excluding the dollar. 1550, 1510 towards the end of the year, and almost 16 at the end of 2023. Now, when we talk about midpoints of the trading range, those, I'm sure everyone familiar with the currency will know, it's a midpoint, and around that you should add at least 50 cents on either side. So that would be a range of at least, 15 to 16, for example, in this second quarter of this year. So at least a 50 cents range And then if you're in sort of an extreme risk-off environment, we could go to towards 17 and 1770 by the end of 2023. So your fair value 3 it shows that extreme risk-off environment, and we add GDP per capita differentials into fair value 3. So that's the fair value 3 has the GDP per capita, commodity prices, and inflation differentials built into it to capture the structural risks that SA faces. So if we look at the inputs to the model, so inflation, this is the inflation differential between South Africa and the US, and you can see that at the moment we're pretty much, it's at its minimum, so it's at its best in terms of providing strength to the currency. And moving forward, SA CPI is going to rise faster than US PCE. So that should put some weakening pressure on the currency. But what I wanted to show you as well is that since Nenegate in 2015, this is, you can see, is the inflation differential in the blue line between South Africa and the US, and that is the exchange rate. And since 2015, and kind of the loss of faith in SA's institutions, you can see that the inflation differential has played less of a role in where the currency trades. And that's really because other factors are had started to play more of a role. So sovereign risk started to play more of a role, and the fact that we were heading into a downgrade, those things have started to drive the currency more than the inflation differential. So just to bear that in mind. Then in terms of commodity prices, what have we put into the model? We make a real industrial, so this is an index that RMB has made. It's the real industrial metal price index, and it's very linked to growth, infrastructure growth in China. In terms of this is, so the dotted line is the forecast. So I've just used the Bloomberg consensus metal prices, industrial metal prices, to forecast this index going forward. You can see markets expect the industrial metal prices to remain elevated, but not increase from here. From a base effects perspective, that means this yellow line here, real industrial commodity prices, are expected then year on year to fall, which you can see puts downward pressure on the currency. So the currency, there is this pressure to depreciate, even if commodity prices remain at these elevated levels. Now, I think what you're seeing from analysts, global analysts that cover China, is that there is an expectation there'll be a lot more stimulus coming from the Chinese government, specifically with respect to infrastructure, stimulating infrastructure build in China. And so I think it's going to be interesting to see how that plays out. But you're starting to see some arguments being made for industrial metal prices actually not only remaining at these levels, but rising from here as the Chinese government continues to stimulate the infrastructure side of their economy. Just to put in perspective what it means for the way that the model incorporates commodity prices. So if you look at how sensitive our model is to commodity prices, you can see this was back in August 2020. So the model's forecasts all the way through to now have fallen. So fair value at at around 16, obviously excluding the dollar, coming all the way down to the 12.90 at the moment. And that's really as commodity prices have risen. You've seen the fair value model, respond to that, and you can see how it's driven the fair value of the currency. So that's really been the main driver there, and you can see how sensitive the model is to those changes in commodity prices. This is the GDP per capita differential between South Africa and the US, and it's basically showing that South Africa's GDP per capita is falling versus what's going on in the US. US wealth is growing a lot faster on a GDP per capita basis than South Africa, and that's what we put into the Fair Value 3 model. So you can see going forward, we've assumed SA GDP growth is 1% on average, and US for this year, and US GDP growth is around 3.75. So that continues to fall quite dramatically, and that's what drives that Fair Value 3. So you can see Fair Value 3, that's quite a lot weaker, and that captures that declining wealth in South Africa. And it's, when you have a risk-off environment, that kind of structural growth problem is priced by your currency, whereas when you're in a risk-on environment, that's not the case. So I also just wanted to touch on the monetary policy implementation framework. So with respect to and I won't go into too much detail around it, but basically South Africa is moving from a shortage of cash to a surplus of cash. So instead of the Reserve Bank having to try and create a shortage of cash in the market and then lend to banks at the repo rate, they are now moving to a system where there's going to be a surplus of cash, and you can invest that surplus of cash or bank it at the SARB at the repo rate. So it's just different ways of transmitting the repo rate through the economy. So repo rate at 4.25, you've got to transmit that through the banking system. It's now being done via creating a deposit rate, a sort of low floor on the deposit rate at the repo rate. And what that means is, that the SARB no longer has to create a shortage. What that's going to mean, and if you have questions around it, I think we can address those in the Q&A session. But basically, at the moment, if you want to short the currency, you have to pay JIBAR plus around 120 to 150 basis points. I know that's quite a moving target at the moment, but that's where it's been. And once this is implemented, which should happen in the second half of this year, to short the currency, you'll only have to pay JIBAR. So basically, the cost of shorting the currency will fall by 150 basis points. Now, obviously, from a monetary policy perspective, that has implications, because part of monetary policy is to protect the value of the currency, because that feeds into inflation. And if your currency, shorting the currency is now going to become cheaper, you need to compensate for that through actually hiking the repo rate. We expect the repo rate will be hiked by at least 50 points in the May meeting, and possibly another 50 in the meeting following that. And that the SARB is going to have to front load interest rate hikes because we're seeing inflation at these current levels. And we've also got wage negotiations ongoing at the moment. So if you've got wage negotiations happening at the same time as your inflation is peaking, you want to send a message that you are going to be aggressive in fighting inflation, so that that peak in inflation is not built into wage increases, because that becomes a longer term inflation problem for the SARB. So these two factors, really, the fact that you're changing your monetary policy framework and it's going to provide less protection for the currency, and you're facing a peak in inflation while you're negotiating wages, and what's happening globally, and the fact that that's putting pressure on the currency, means that in order to protect the currency, we're going to need to see a more aggressive SARB. So these forecasts are based on a more aggressive Reserve Bank, front-loading interest rate hikes and 50 basis points at the May meeting, and potentially in the July meeting as well. That's it from me. So back to you, Kim.
Thanks, Kim. Sorry, there's a bit of a delay. Thank you, that was very insightful. With positive sentiment towards South Africa being largely a commodity story, John, why is it not providing as much of a buffer with commodity prices still being elevated as we saw in March?
Okay, thanks, Kim. Guys, just the camera across to me, please. Yeah, good question. I noted earlier that there's been a reassessment from markets towards commodity equities and towards commodity currencies. What does stand out is that actual commodity prices themselves have not been nearly as bad as we've seen the commodity currencies, for instance, swing. So yes, commodity prices have come off over the past couple of weeks, but only marginally, and on an absolute basis, commodity prices are still relatively high. For instance, just to put this in context, if we use our terms of trade index, the terms of trade is export prices divided by import prices. Our terms of trade are still at levels, okay, we're well off from the March high when coal did so well, but we're still at levels equivalent to the middle of last year. And in the middle of last year, dollar rand traded down to 13.40. Now, I'm not suggesting dollar rand's heading for 13.40 again, but I have to agree with the premise of your question that assumes commodity prices are strong. They are actually strong. Yes, they're off their highs, but still very strong. Just to give you some numbers, coal has been the big mover this year. The coal price has generally been $60 to $80 per ton. That's Richards Bay export prices. Coal got up to over $400 per ton and is back at $300 per ton. So yes, it dropped from 400 to 300, but the 300 relative to the long-term average of 60 to 80 is still extremely good. So to put this another way, South Africa is going to continue to run large trade surpluses. Last year, we had a couple of surpluses in the 50 to 60 million bucket. The latest figure from South Africa was in March when the coal price did so well. It was 46 million. Presumably, the trade surpluses going forward are going to be a little bit smaller than that, but still very positive and provide support to the rand. So your question is, well, why is that not impacting on the rand? Why is the rand not strong if commodity prices are strong? Indeed, you look at Kim's model and it just emphasizes the importance of commodity prices when we estimate fair value. Well, the bottom line is that we're in a period of market turmoil, and in a period of turmoil, fundamentals don't matter all that much. We saw that very clearly at the beginning of the pandemic. The rand got up to 19. Actually, in that period, commodity prices were holding up very well. So in other words, when you have global financial market turmoil, fundamentals don't matter so much, and it's volatility, sentiment, and what's happening in other financial markets. Now, Kim has argued that, look, US rates are going up. We're in for a long haul in terms of uncertainty over that. And so further financial market volatility is probably assured at some stage. But the important point, I think, is also to emphasize that if and when we get an easing in global financial market stress, then the rand can come down, the rand can strengthen quite considerably. And indeed, we saw that after the Fed meeting last week, dollar rand got down to under 15.50. It was very brief, but it just shows that when some of the stresses ease, the rand can do very well. So let me just repeat that point. When we're in a period of financial market volatility, fundamentals don't mean much, but as Kim models emphasize and as high commodity prices emphasize, they're saying the same thing, fundamentals towards the rand are still very good at this stage. So if and when the turmoil eases, the rand should strengthen. Kim, just to move on to a few other issues. The driver of financial market turmoil this year Obviously, it's been the war and it's been Chinese COVID. But the most important one undoubtedly is high US inflation and the Fed hikes, again, as Kim emphasized. Just to make the point that today we get the April US CPI figure, it is psychologically going to be very important. March US inflation was at 8.5%. The April figure is expected to be 8.1%. So we've passed the peak in terms of US inflation, and psychologically that's very important. Of course, we're now dependent on how quickly US inflation comes down, and any figures that are higher than market expectations will continue to roil financial markets and of course the rand. Also, just to note that over the past year, 8 out of 12 US inflation prints have come in higher than expected. Only 1 has come in lower than expected, and 3 on the consensus forecast. So we've repeatedly had to deal with this fact that US inflation has been higher than expected. Hopefully, as it starts to ease, that is no longer the case. Kim, just to come back to my point about the financial market turmoil, Kim Silberman can tell us she speaks with international investors on numerous times every week, but the sense from international investors is they are very positive towards South Africa. Our growth, our current account, our politics is stable, our fiscal accounts are doing better. We're obviously a commodity exporting country. Our yields are good. The JSE price earning ratios are not high. Nevertheless, coming back to the point about the fundamentals, in this recent period of financial market turmoil, what we've seen is meaningful outflows from our bond market. Once again, in a period of volatility and uncertainty, the fundamentals don't mean so much. And in a practical sense, the large outflows have been offsetting some of the trade account inflows. Again, hopefully, once that turmoil slows, some of those inflows from offshore will resume, and maybe we ask Kim Silberman a question on that later. There has also been a major change in exchange controls in South Africa. I always joke it was hidden away on page 160 in the budget and took us 2 days to actually notice, but arguably this is the biggest change in exchange controls since 1995. What it is that institutional investors, so pension funds, life assurers, etc., are now able to take significant larger shares of their assets under management offshore. Practically for pension funds, the limit has been shifted from 30% of assets to 45%. So significant easing and in the allowance of permitted capital outflows. Now our work shows that potentially this can generate huge outflows and probably will over time, but it certainly doesn't generate a rush for the door and sudden outflows. But the ex-con relaxation has the implication that probably we will continue to see large outflows from South African investors as we shift offshore. Kim, 2 last points. We have a SARB meeting next week. Kim Silberman mentioned that. Are they going to do 25 or 50 basis points? That's a big event risk coming up for South Africa. Usually the rand isn't all that sensitive to actual MPC meetings, but this one is going to be an exception. Last point then is just on the reforms going on in South Africa. Our chief economist Etienne Leroux has been mentioning this for a while, that reform is making progress, and if you start digging into the details, there are surprising number of positives there. And the presidency announced their Vulundlela report earlier this week, specifying exactly the same thing. Let's not overplay it. A lot more reforms needed in South Africa, but it's certainly the news on that front has been good. Last comment then is continuing on the positive news. We've been running a series of webinars with political analysts this year, looking forward to the ANC elective conference at the end of the year. It seems pretty certain that President Ramaphosa is going to return as president of the ANC. There will be significant changes in the top 6 and indeed in the NEC, and it's possible Ramaphosa will come back more empowered after the Congress. Okay. Kim, the bottom line from my side is to support what Kim Silberman is saying. Her model suggesting a stronger rand Fundamentals in terms of our trade balances are still good. Fundamentals of how foreigners are looking at South Africa are still good. Yes, there is an offset from potential capital outflows from locals after the ex-con release, but generally the fundamentals remain positive for the rand. 2 points there. Fundamentals don't mean much in a period of market turmoil. So if we continue to see market turmoil, then we continue to see deviations from the numbers that Kim has pointed out. And then most importantly, arguing that fundamentals good. Fundamentals are good, but we have to continue to watch commodity prices. US equities have come off significantly. Global interest rate markets have been badly affected. If we start to see significant weakness in our export prices, then obviously that comment about fundamentals towards the rand being good will have to change, and on a more structured long-term basis, would have to become negative, more negative towards the currency. Thanks, Kim, and back to you.
Thank you, John. Apologies for the delay there with the camera, which has had some connectivity issues. Okay, moving on to Shanila. Shanila, can you tell us what you are currently discussing with clients? So from a practical perspective, how are clients able to manage their exposure to the currency based on the current environment?
Good morning, everyone. Thank you very much for that, Kim. Yeah, so interesting times where the rand's weakened quite significantly, and we've seen a lot of interest from our exporters being corporates that are selling currency. And typically in this environment, the type of structures that clients would enter into are sort of collars, where they've got a floor, a minimum rate, that's their worst case rate, but the potential to participate on the top side. So we've seen a lot of interest in that. That's a commonly used product in the market. Then we've also seen clients use what we call geared collars. This prices also very, very favorably when the rand is weaker. So you do get a floor rate, but at the same time, relative to the collar, your top side is improved even more significantly. The psychology of the rand is such that when we were at 16.14, there are clients that are holding back and thinking, no, the rand will get weaker. And we've seen that from 16.14, we've come back. Currently, the rand is trading at 16.05. We encourage all exporters that are, exposed to currency risk from a selling perspective that they take this opportunity of entering into collars or geared collars. But we also like to, emphasize, and this is what we discuss with our clients very often, is to use a portfolio approach. And I think that would work very well. So in the portfolio approach, we're saying, well, do a percentage of it in forward exchange contracts, because the rand is at favorable spot rate, plus you get forward points. And so your FEC rate will be quite favorable, and then do a percentage of it in spot, and then do some of it in options. So the portfolio approach historically has worked quite well for most clients. And, if there's any more queries about that, I'm willing to discuss that in a lot more detail. So, yeah, and, this is when the rand is weak, it is in an environment that's favorable for exporters. But then the big question comes in, well, what do the importers do? Because it's quite concerning. Given the market events that are going to transpire later this afternoon and even next week, if the rand goes to 16.30, what does an importer do? You can't just sit back and say, well, the rand is going to get, we will wait for the rand to move in our favor. We do have structures that will be able to assist clients to manage that type of exposure. We've got premium paying structures, and we've got non-premium paying structures. So your premium paying structures will typically be your call option, which I really call like an insurance premium. Just like you pay insurance for your house or your car, you can pay insurance on your currency. But at the same time, you protect it. But if the rand comes back to a stronger level, there's some level of participation. But obviously, in this type of structure, you're going to have to pay a premium. So for example, I just did a rough calc on a 3-month, $1 million call option. for $1 million, you're looking at close to almost R500,000 rands that you're looking to pay in premium if your protection is at the forward rate. But we can structure these solutions in such a way that we can make the premium a little less by adjusting the strike rate. Again, you'll have to contact me and we can go through the detail. And if you're not happy to pay premium, we also have what we call participation forwards. Participation forwards work very well in a scenario like this, because, like I said, I mean, you're an importer, you've got exposure in 2 or 3 weeks' time. Can you just sit back and say, I'm not going to do anything? Definitely not. What you can do is say, okay, if I've got $1 million exposure, at least for $500,000, let me enter into a 25% participation. The bank gives you a worst case rate. You're not going to do worse than that rate. That rate might be in your budget rate. But should the rand return to stronger levels, I mean, could get to 1580, then you'll have some level of participation where you're able to recoup some of your forward points. So at the same time, while you're being protected from a significantly weaker rand, you also have some level of participation. So yeah, there's a lot of structures that are out there that we can discuss in more detail. We are talking to clients and we are saying to them, try and use the portfolio approach, but whether you're an importer or you're an exporter, you need to do something. By not doing anything, you're effectively taking a very big risk in terms of taking a view on the currency. And we know how wrong we all can be. When you think the rand is going to be stronger, it gets weaker and the other way around. Thank you.
Shanella, thank you so much for that. Okay, perfect. We've got some questions coming through. If you don't mind, we just want to go through it. Okay, so from Warren, the risk-off differential just doesn't seem fair for the rand and begs the question, who is behind the huge differential and stands to gain from it? So it's certainly not the J&Co. And what can the SARB implement to narrow or prevent such volatile swings? John, I see your hand is up. If you could please take that one.
Yeah, thanks, Kim. Thanks, Warren. Yeah, I'm not sure I get the question perfectly, but just to make some general comments. The rand is extremely volatile. And in terms of answering your question, we should probably ask why the rand is so volatile. But to make the point, in global markets, we have typically assets we call risk on, and we have risk assets and we have safe haven assets. So typically when you get periods of uncertainty, Swiss franc, Japanese yen, US treasuries, bonds in the developed world generally do well. Equities and currencies such as the rand do badly. Now, to understand why the rand does badly in such a period, we should again go back to why is the rand so volatile? Well, the rand's volatile. One, we have high inflation in South Africa, typically relative to the rest of the world, which means we have higher interest rates, which make us susceptible to hot money flows. Two, we're a commodity exporting country, and obviously commodity prices themselves are very volatile. Three, we're an emerging market. And four, we have a central bank that historically got burned from intervening in the currency and has taken a more hands-off approach. So in terms of what the Reserve Bank can do to change that, probably the only thing that they can really do on a sustained basis is if we reduced our inflation target down to levels more similar to that of the developed world over the long term. In other words, inflation closer to 2%. That then would reduce some of this hot money flows to South Africa and reduce the volatility in the rand and indeed the rand sensitivity to risk off. There is, of course, the ongoing question about intervention in the currency. Not to get into that in too much detail, but South Africa has had a terrible relationship or terrible history with intervention, the SARB having been burned repeatedly trying to protect against sudden bouts of rand weakness and losing significant amount of money. So learning by doing has taught us that that's not the way to do it. Warren, the bottom line is this is just a reflection of global financial markets. It's not going to change. Whenever we have shocks globally or locally, the rand is going to come under significant amounts of pressure. And I think Shanila made a very good comment there. In my mind, importers always need to be heavily hedged in South Africa because you just never know when the rand is going to run. And Shanila spoke about some of the hedging products, and I've just got to agree completely with her. Thanks, Kim. Back to you.
Thanks, John. Okay, Kim Silberman, if I can perhaps pose this question to you. The impact of Eskom's announcement to start introducing load shedding again and at a substantial pace, what sort of impact is that going to have on foreign investors' outlook into South Africa and essentially the impact on our bond inflows?
Yeah, I mean, it's ultimately negative, right? It puts a cap, for me, the way that I look at load shedding is that it puts a cap on real GDP growth. So while commodity prices, if they stay at these levels or improve a bit from here, that affects the value of your GDP. So that's your nominal GDP. But it doesn't, unfortunately, it doesn't affect your volume of output, because we are not able to increase the amount of the volume that we get out of the ground and that we export if we have what's going on with Transnet and what's going on with Eskom. So, for example, coal exports, we're looking to export less coal, substantially less coal this year than we did last year, and less coal than we did 10 years ago, because of what we're seeing with the rail, transport freight rail to the Richards Bay coal terminal. So that tells you, from a GDP perspective and from a tax perspective, we benefit from high commodity prices, but to a lesser and lesser extent, because we're not able to produce more and more volume. So Eskom, for me, caps growth at around 1%. Our real GDP growth, it's difficult for us to grow more than 1% with load shedding, and until Eskom really starts to increase its operational supply. So that from a tax perspective will become a structural risk for investors. I think it's not going to have as much impact this year because commodity prices are high, and we're still looking to, we finished last year with a tax revenue overrun of around 17 billion. And this year we should come out okay because commodity prices are still high. But what it means is that over the sort of next 3-4 years, offshore investors are hesitant about South Africa's the sustainability of our fiscal position, and the fact that our borrowing costs are just so much higher than our GDP growth. So it ultimately puts pressure. Either our yields have to increase, or we're going to sell less bonds. And we know how the market works. Our yields are going to have to rise to the point where they become they entice offshore investors. But it essentially is it's rand negative from a capital flow perspective. So what it also, if you look at it from a model perspective, that fair value 3 is where it would come into our model, and it would mean that in a risk-off environment, the rand would spike at higher and higher levels. So it really, I think that's when when it's risk on, no one really cares about your domestic fundamentals, and when it's risk off, then everybody cares what your current account and your growth looks like, and you start to see the currency, selling off to higher and higher spikes. Thanks.
Thanks, Kim. Very good point. Okay, we've run out of time, so I'm not going to take any more questions, but thank you so much for joining us. We appreciate your time, and thank you very much to our speakers for all your insightful information. Have a good day further.